Done writing? No. Now, first thing, that this is the typical format in which you will be seeing income statement. The ones that we learn horizontal, that is good for learning purpose, but that's more relevant from an academic purpose. The entire industry, not only in India but generally everywhere, the format which would be used is going to be similar. Now there are certain terms that we want to learn. Now, which is the first line in your income statement? Revenue. This also means your sales, the amount of sales that you've made. Since this is the first line of your income statement, at times people generally directly call this as top line. So if you read financial newspapers and someone says there is a substantial growth into our top line, that means they mean to say that there is substantial growth into the sales in this particular year, revenue of that particular year. In the same fashion, what we have as the last line here is your net profit or net income. Income and profit are proxy words for each other. So you have your net profit here. At times we also use earnings as the word. Since this is the last line of your income statement, people also call this as bottom line. Right? And these are fairly common terms. So you'll hear companies saying that there's been a decline in our bottom lines. That means the net profit of this particular year has declined. Or YOY bottom line has been increasing by 5%. So year on year the growth in bottom line is 5%. Now, the next component that we have here is called as COGS, cost of goods sold. Now, those people who've done trading accounting in the past, how many of you have done some accounting in the past? Okay, very few. Then we typically prepare something called as trading account, and that trading account gives us gross profit. Right? In vertical format, the entire trading account is prepared in one line. And what is that line? COGS. So whatever things are used to put in your trading account would be directly put into COGS. For those people who have not done it, understand this properly. See, my intention of building this income statement is, I want to show the reader that how much cost has been spent on what component of the business. Right? So typically the first number that I calculate, which is my COGS, this COGS is generally all direct manufacturing cost. All direct manufacturing cost goes into COGS. So what is COGS made of? Let's say you're into a trading business. Trading means buying and selling. So you're not manufacturing anything. So let's say you buy something for 15 rupees and you sold it for 35. Then you would say your revenue is 35 and then COGS, cost of goods sold, is 15. So 35 minus 15, your gross profit. Okay. When you deduct the COGS from revenue, you get your gross profit. Your gross profit is 20. But this 20 is not the ultimate profit you have, because apart from the goods that you purchased, you will have a lot of other costs. You will have employee salaries, or you will have electricity bill, you will have taxation, you might have to pay interest. So from my gross profit, I am going to deduct further numbers so that I can get my net profit. So COGS is all about what was the cost that was incurred for manufacturing purpose. Now in a typical manufacturing entity, the cost that would go into my COGS is going to be primarily three. Number one is raw material. So let's say you're into business of manufacturing water heaters. So you buy the raw material per heater, which is, let's say, it's costed you 600 rupees. Then you need labor to process this. So labor per heater is, let's say, another 100. And then you've spent some direct cost on it. You might have incurred some electricity or some other related cost. So all other direct cost, at times we also call them as overheads. So these costs are 100. Which means my total cost to manufacture one unit is 800. So this 800 is going to my COGS. That means on a vertical income statement, you will not see a separate line showing raw material expenses. You will not see a separate line which will show electricity, manufacturing electricity expenses. There would be only one line, combined all the expenses together, and which would be your COGS, COGS, your manufacturing expense. Logistic, yes. it depends whether it's inwards or outwards. So we typically say that freight, generally inwards is a part of manufacturing cost. And outwards we generally put into sales cost, sales and distribution cost. Okay, have you understood this part? Yes. Now a very final point. Let's say I purchased raw material in 2008 for 5,000 rupees. Now, what is the amount of expenditure that I've incurred in 2008? Have you understood my question? I have purchased raw material of 5,000 in 2008. The amount of sales here is 0. Let me just make the whole thing. 2009, 2010, 2011. Sales is 0, 0 and sales is 15,000. Now, my question is, if this was the transaction which was done in 2008, my expenditure is going to be 5,000? Yes? How much, Ankur? If I purchase raw material of 5,000 rupees, my expenditure in 2008 is how much? 5,000? Do you agree? Yes. Is there anyone else who thinks other way around? 0? My expenditure in 2008 is 0. Why? That raw material that I purchased, I will still have it with me at the end of the year. I can use it for next year. Right? So the fact that I still have that raw material with me, that raw material of 5,000 is my asset, which would be on my balance sheet because I have not consumed it. Expenditure will come when I consume this. So this entire 5,000 is going to be my asset. My expense for this particular year is going to be 0. Are you clear? Now what I do in 2009 is I take this raw material and then I decide to process it. So I incur labor charges on this. Right? So let's say I spend about 2,000 on my labor. Now my sales in 2009 is 0. What would be my expenditure in 2009? 2,000? 0. The answer is 0. I've spent 2,000 on my labor, but my expense in 2009 is still 0 because this amount that I've spent on my labor, this amount was helpful in increasing the value of my inventory. Right? So probably I had only raw material now it has become work in progress. So now I would say my expenditure in this year is 0. That 2,000 that I've spent, that will increase the value of my inventory. So my inventory is now worth 7,000. Are you clear? Yes? Now in 2010, I start packaging my product. So I spent 3,000 on packaging this product. Now what is my expenditure in 2010? 0. Because now the value of my inventory is 10,000. In 2011, I don't incur any expenditure. I don't spend any money. But then I sell my goods. Now what is my expenditure in 2011? Now my expenditure is 10,000. And that 10,000 would be called as cost of goods sold, COGS, and my gross profit will now be 5,000. Do you follow? And why is this happening? This is happening because of a concept called matching concept. That if I am making sales in 2011, all the costs that I have incurred which helped me to make that sales in 2011 should be charged in the same year itself. So if my sales is in 2011, my costs are going to be in 2011. Are we clear? Have you followed this? Yes? Okay. Now in case if you've done trading account in the past, then you might be thinking, Ankur, that we used to show this on the debit side. Right? Then why was it not the expenditure?
Yes, think the same. Continue the same means we show it in the profit and loss account debit side.
And
charges and
you have that question.
Yeah.
Okay. See, those who have not done this before, don't worry. That there is something called trading account which is traditionally taught to accountants, where on first side you write all manufacturing related expenses, on the other side you write down your sales. So now let's say 2008 you would say your sales is 0. First year raw material purchase was 5,000, which we have written on the expense side. But do you also remember that we used to write down something here? Closing stock, how much? 5,000. Is there a net effect? No. No expense. 2009, you will say opening stock 5,000. Labor 2,000. But closing stock would be worth how much? 7,000. Is there any expenditure? No. So till the time I do not sell it, because if I sell it in 2011, my closing stock would be 0, right? Then I would have that expenditure. Because in 2011, I will have opening stock as 10,000. Last year, I will have opening stock as 10,000, inclusive of packaging, but my closing stock will be 0. So automatically I will have expenditure of 10, I will have sales of 15,000. So then I will have gross profit of 5,000. Are we okay with this? Okay. So you've taken care of first 3 components. We know what is revenue, we know what is COGS, we know what is gross profit. The next item is called as selling, general and administrative expenses. We would be calling this throughout level 1 curriculum as SGA. SGA. So this is how this is shorthand. We simply say it as SGA. And what does SGA include? All other costs apart from the manufacturing cost, depreciation and interest, you club into SGA. That means your sales cost, marketing cost, advertisement cost, your outward logistic, outward freight, all other costs would be clubbed into selling, general and administrative. If you want to know the detailed bifurcation, you can go and see the notes to accounts. Right, so every annual report will have certain notes attached to it, and if you want to see exact bifurcation, you can go and see those notes. On the income statement, they would just give you a single line here. Next component is depreciation expense, and of course what we've already studied is depreciation is, what is depreciation? Non-cash. It's a non-cash expense. It is reduction in the value of assets. When you use some asset, value of that asset reduces every year, so we charge depreciation. Let's say you purchase an asset in 2008 for 1 lakh rupee, and the life of this asset is 5 years. So what you want to do is that every year you want to reduce the value of this asset in such a way that after 5 years value of asset would be 0. So what you decide to do is that every year, instead of showing 1 lakh as expenditure today, every year you will show expenditure as 20, 20, 20, 20 and 20, so that automatically in 5 years your total expenditure is 1 lakh. But what is the point of time when my cash is going out? Is it going out here or is it going out here? My cash went out when I purchased the asset. So when I initially purchased, I spent 1 lakh, but for 5 years I kept on showing 20, 20, but I wasn't paying cash to anyone. I was simply reducing value of my asset. And that's why we call depreciation as non-cash charge or non-cash charges. That means your cash does not go out when you show this expenditure. So if your sales is 100 and your depreciation is 20, which is one of the expenditure, your profit is 80. But how much is your cash? 100. Your cash is entire 100, which means not necessarily that amount of profit and amount of cash are going to be same. Are you finding this a bit slow? No. It's a slow? No, not it. So once I deduct this, here all those components from my sales, I have reduced COGS, I have reduced SGA, I have reduced depreciation. What I get after that is an extremely important number called as operating profit. Operating profit will also be called as PBIT, or we are going to also call this as EBIT, not EBITDA. We are going to call this as EBIT. So EBIT is earning before interest and taxes, profit before interest and taxes. So now let's understand why this number is very important. Let's take two companies, let's say in IT. First company will call this as A and next company will call it as B. Now the total capital that has been invested into both the businesses, both business A and business B, is 1000. Right? So total capital is same, 1000. Capital 1000. But in case of A, which is a conservative company, this entire capital is the one which has been given by the promoters. That means owners invested this entire 1000. That means entire 1000 is, we call owners' money as equity. So entire 1000 is equity. Whereas in case of company B, which is an extremely aggressive company, a risk-taking company, they have decided to invest their own of only 100. Remaining 900 has come from debt or loan. So though their investment in the business is 1000, 100 is their own money, 900 is the amount which has been invested through bank. Now let us say that both of them, since they have same amount of capital with them, they make same amount of sales. So for simplicity, we'll assume that sales per year or in this particular year is 1000. Now, company A has incurred expenditure on, let's say for IT company, the biggest expenditure is going to be salaries. So this is sales here, this is salaries. Company A has incurred salaries of, let us say 600, which will give us the total profit as 400. Company B, they have incurred an expenditure of 200 on their salary. So they get 800, but now I will have one more very important component of my expenditure. Let me make this as 400, it would be easier to compute. This is 600. Which would be other expense that company B will have? Interest. And that interest would be how much? Let's say that interest is 300. Okay, I'm just taking a round figure. So that net profit is 300. Now see, what we'll typically do is, we'll look at these two companies. We'll say size of capital, same. So this company has been able to earn 400 by making sales of 1000. So we'll calculate one number. We'll typically call this as net profit margin. If I make sales of 1000 and my profit is 400, my net profit margin is how much? 40%. So my net profit margin is 40%. What is the net profit margin of this company? 30%. Which one is better? Of course this one, isn't it? 40% is a smarter number, more net profit. But then apparently it seems that company A is really smart and efficient because it's got more profit margin. But if you go slightly in detail, right, so you want to say that let me do a slightly in-depth exercise, then what you say is that the core expenditure of this company is salary, and which is what percent of sales? 60%. And what is the core expenditure of this company? Salary again, which is what percent of sale? 40%. So don't you think that this company B, is more smarter in its operations? Right? Because with less number of employees or less number of employee costs, it can generate more amount of revenue. Right? So this number that we have here, 600, this number is called as the operating profit of the business. Right? And why operating profit? Because the next cost that we have, this 300, which was the interest cost, this is called as non-operating expense. And it makes sense because whether to take loan or invest my money through equity capital, that's a business decision. That's a decision which is related to my financing. It's not a business or operations related decision, isn't it? What would be operations related decision? Do I have to send 10 employees on this project or 15 employees? That's an operational decision. But how much loan is to be taken, how much loan should not be taken, that's a financing decision. That's why we say that when you want to compare companies, you should never compare these numbers. They might give you wrong indications. The ideal number that needs to be compared is operating profit, which is 400 and 600. In this case, since sales is same, we can compare the absolute amount. But ideally what we want to compare is that my operating profit is 400, my sales is 1000, so my operating profit margin is 40%, and my operating profit margin here is 60%. And now we would say that company B is smarter in terms of operations compared to company A. We follow this? So do you agree that company B is better? You want to ask any questions? So I am telling you on day one of your FRA that company with lesser profit is better than company with higher profit. Agree or not? No? Company A is still better?
So in the long term, like B would be better.
In the long term, B would be better?
A will be better.
In the long term, A would be better?
They have taken loan.
So we still have to consider other expenses also.
No, if this was the case, if these are all the expenses that I have. See, at this stage, we would, generally we would start looking at the stocks from an equity perspective. It means perspective from an equity shareholder. That means you are the one who's invested this equity of 100 and you are the one who's invested this equity of 1000. Now, what we also know is that this equity of 1000 is the profit. This profit of 300 or 400 is a profit that belongs to the owners, right? So as an owner, now see, same level of sales, same level of capital. So owner invested 1000, he got 400 rupees in year one itself. That means what is his return on equity? 40%. Return on equity for owner is 40%. Return on equity means how much money did I earn on my own investment? It is 40%. What is the return on equity for company B? 300%. That from the owner's perspective, he is making 3 times more money than, or he is making substantially higher money than what company A is making. And it's only because he is playing on this debt. And later on we'll start calling this as leveraging. I think we covered this part. So that company B is highly levered and it is playing on debt to extract profits from here. Are you clear? So the point that we want to compare, I'm repeating it again, the ideal point of comparison is not net profit. Of course net profit is good, but a more important number is your operating profit, which is earning before interest and taxes. Are we good? Okay. So next one is interest expense. So that what you get is income before taxes. We also call this as EBT, earning before taxes, or even PBT, profit before taxes. And then from that you reduce your taxes. So you'll get profit after tax from continuing operations. Now let's understand what this means. Continuing operations here. Okay. Do you know that HUL at one point of time used to have about 150-160 branches in India, and they went to this firm called McKinsey. They said that things are not going so well for us, can you help us? And the advice that was given by McKinsey is that you are just doing too many things at the same time, you need to focus, so cut down on the branch, right? So they did sell a lot of branches, they did outsource a lot of branches to other companies. So now why I'm talking about this, let's say there's a company which has got 4 business units, A, B, C and D. And now suddenly this company thinks that this D business is not profitable for me anymore, I want to get rid of it. I don't want to be in D business anymore. Right? So let's say this D business is a paper manufacturing unit. Okay, so I have a paper manufacturing unit, I want to get rid of my unit. If I decide to do that today, will I be able to sell it immediately tomorrow? No, it's a business, right? So it is going to take me time. Now, let's say a customer comes to me in this year, I have decided to sell my unit D. If he comes to me and says that I want to buy some papers from you, will I say no to him just because I want to close down the business? No, if there is an opportunity to make money, I will. Right? If there is an opportunity to make sales in that particular year, till the time I don't stop this operation completely, I will. Which means I will also have, I might have some profit from D. Right? So let's say that profit from A was 100, 100, 100 and 150. So total profit of this company is 450. So if I put 450 into my profit and loss account, someone who is reading my financial statement, he will look at my profit of last year, he will look at my profit of this year, he will say I want 450, then he would make an assumption of growth rate. So he would say that next year probably my profit would be 470. But then what he does not know is that next year I will not be having this 150. So therefore, to inform my investor that there might be a unit which would be discontinued, what I'll simply do is I'm going to report my normal profit as 300. Then at the end I would say profit from discontinued operation 150, so that net profit is 450. So this item here. The last one which says earnings or losses from discontinued operations net of tax, and then finally what you get is your net income. Are we okay? So now answer this. C. Shitish thinks it's C. Vinay, you're A. Ratnesh. Ratnesh thinks A. Ankur. C. Tanmay thinks C. Sarang. Yeah, there had to be someone. Good. अभी कोई ना कोई तो सही होगा. हाँ, संग्राम, दीपक, अजित. Okay. The answer is C. Gross profit, if you'll go back to your income statement, it is saying sales minus cost of goods sold is your gross profit. Sales minus cost of goods sold is your gross profit. Now, which means if my cost of goods sold is higher, my gross profit is going to be lower. So I need to know that which components will increase my cost of goods sold. So you think of it this way, that let's say this is my factory here. Okay, this is my factory, and this is a place from which I purchase raw material. So from the time I purchase my raw material, I bring that to my factory. So this transportation cost again will go into my manufacturing cost. Then I start processing here. So I have labor, I use electricity, right? All those expenses that I incur here, all these expenses are going to be part of your COGS. But once your goods are manufactured and you take it outside your factory, then you might have sales costs, you might have distribution costs, you might have 10 different stores where you're sending them. These costs are not going to be a part of your manufacturing cost. So here it says that increase in the cost of raw material. If the cost of raw material increase, my COGS will increase. My COGS will increase, my gross profit will decrease. So the answer is yes. If there is an increase in cost of raw material, my gross profit will decrease. But then if my marketing expenses increase, which is not my manufacturing cost, if my marketing expenses increase, my total profit will decrease, but my gross profit will be same because it comes after my marketing cost would be part of HGA, selling general and administrative expenses. So the answer is C. Are we okay?
There's a doubt.
Yes.
We are saying that immediate production of inventory.
Yes.
So does it imply that all the COGS which you have spent might have gone into it?
All the COGS?
We are increasing inventory by putting expenses in the...
Okay.
So it is, if it is not sales.
Okay, so you are assuming what it is not sold. See, but we cannot assume that nothing would be sold. at least something would be sold. So at least that something would be now at a higher cost. Right, which is a normal assumption. You generally would not assume that there are no sales. There might be some sales, but
You
now
just mention them, used in production of inventory.
okay. See, the confusion might be, we typically have raw material, we process this, so what we get is work in progress. Then this work in progress is packaged, what we get is finished goods. All three of them collectively called as inventory. So inventory is a generic term which means all three of them. So raw material used in the production of inventory simply means your manufacturing cost, nothing else. Should we move on? Both should be included. Okay. So you think it's B? Shitij. B. A. Vinay thinks it's A. Monica A. Sarah, no one has said C yet. C. What do you think? Ajay. Okay. This question will take us some time. The correct answer is C. What is to be recognized is this one. What is not to be recognized is this one. Okay, so let's understand properly why. We'll first spend some time on this term here. Created, though not directly required in CFA, but I think you should know what debit and credit is. Yes, credit means add it to your account. So, see, there are these two concepts, debit and credit. Right. So, the person who invented accounting, what he said is that these are just two separate boxes, and if there is a transaction of amount 300, what he is going to do is that if this 300 is on credit, that means 300 is a credit nature, I am writing it on credit side, I will try to nullify this credit either by increasing debit here or by reducing some other credit. So what do I mean? If you remember, let's say we have a balance sheet here. Okay. On this side we have assets, on this side we have liability. Let's say you have cash of 1000 and you have loan of 1000. That's how your balance sheet is today. Now you purchase an asset of 300 rupees. So let's say you purchased one building for 300. So building will come here 300. Second effect would be cash will reduce. So which means this would become 700. So now typically this side is called as debit. Okay, I'll tell you what is what. So what we have done is, if 300 was written on the debit side, we gave a corresponding effect by reducing another debit by 300. So the whole thing tallied. Had this not been purchased in cash, had this been a credit transaction, then cash would have remained same, but then we would have had one more liability towards this 300. So we would have said liability towards building 300. Now what we have here is called as a credit. Right? So what I did was, when my debit increased here, I increased my credit. That means an increase in debit can be compensated either by increase in credit or decrease in some other debit. And same is the logic that goes on for credit. So an increase in credit will be compensated either by an increase in debit or by decrease in some other credit. So the question is now, how do I understand what is debit and what is credit? Now there is a very simple technique to understand this, though it's not generally the way it's written in accounting books, but it will help you to understand this concept. You think of it this way, that when money goes out, it is a debit, right? And when money comes in, it is credit. So what does it mean? How, on which all possible occasions money can go out? When I make expenses, my money goes out? Yes. So all those expenses that I'm going to incur, salary cost, electricity cost, whatever might be the expense, all of those are called as debit. And simultaneously, when I purchase an asset, money goes out. So if I purchase an asset, again that is going to be debit. When does money come in? When I earn some income, money will come in. So that's going to be a credit. Money will also come in if I take a bank loan. That means when I incur some liability, so that's going to be credit. And then the total of this side and total of this side always should be same. So total of debits and total of credits is always same. So now for those people who've done level 0, we prepared a balance sheet here, right? And we prepared a profit and loss account here, right? So this side we wrote down income, this side was expenses, this side was liability, this side was assets. Liabilities was what? It was credit. Assets were debit. Income is credit, and expenses are debit. Now see, what is the whole logic behind this? If I have income of 1000 here, if I have expense of 300, how much extra credit do I have? 700. That extra credit is what? Extra credit is your profit. And where did we transfer our profit? We transfer our profit to? Oh, I wrote the other way around. Okay, fair enough. So I transferred my profit to liability. Did I have written the other way around? Did I transfer my profit to the liability side? Yes. That means that extra credit that I had in my income statement, I just transferred those extra credits to the liability side. That means the credit side on my balance sheet. So that's how your balance sheet tallies. Have you followed this? So now, let's say if I receive cash, okay, if I have received cash by making sales, so we say that this transaction will typically have two effects. One effect would be my sales, which is my income. Second effect is my cash. My cash will increase. So when my cash increases, cash was what? Debit or credit? Money is coming in, so cash is debit. So my debit increase here. Sales is what? It's an income. Income was what? Credit. So my credit increase here. Balance sheet tallied. Next example. Let's say that now I spend cash and purchase an asset. Spend cash and purchase an asset of 100. So now my cash is going to reduce and some other asset balance is going to increase. Cash is what? Debit or credit? Debit. Asset is what? Debit. So here a decrease in debit is compensated by increase in debit. Can we follow this? So you go to an ATM, okay, and you spend some money. You go to an ATM, you spend some money. Immediately you receive an SMS from your bank which says the amount has been debited. So now it doesn't make sense, does it? Because when you spend money, your cash is reducing. Your cash is reducing. So debit balance should be reducing. But it says amount has been debited. Why does it do that? See, bounces are from a bank's perspective. Yes, I think I should cover this. That if you have a debit balance, let's say if you have an asset, this asset is of nature of debit. So asset will increase if there are more debit transactions. An asset will decrease if there are more credit transactions. Which means if you have cash, right, and if your cash account is increasing, we will say that your account has been debited. And if your cash is decreasing, your account is credited. So if you have a cash account, or let's say आपके पास 100 रुपया है, someone comes and gives you 50 rupees, we will say that please make a debit entry into your cash account for 50, so that debit is the nature of your account, 100, you made one more debit entry of 50, so total amount is how much? 150, right? So a debit account is increased by debit and it is decreased by credit. A credit account is increased by credit and it is decreased by debit. So ideally, if you prepare your cash account and if you deposit money into bank, then you should say that I have debited my cash account. You should say that. But from a bank's perspective, your account is what? Your account is a liability for bank. Liability means credit. So if there was 5,000 rupees in your account, that means bank had a liability of 5,000. When you withdraw 500 rupees, bank's liability reduces. That means bank's credit reduces, and that credit reduces by putting a debit entry. So that's why bank says your account has been debited. When you deposit money into your bank account, what would bank say? Your account has been credited, because now bank's liability is increasing. Are we okay with this? Why? Why our account is a liability? Let's say you go and deposit 5,000 rupees in a bank. Now, if you go to bank next day and say that I want my 5,000, if bank says no, I'm not going to pay you, then people will stop depositing money to bank. Right? The fact that people deposit because they know they can take it back. That means bank is supposed to pay you. So it's a liability. Is bank earning you 5,000 when you deposit? No, what is bank earn? See, I'm sorry. Do you know that you get those preferred accounts with banks? So, I don't know if it's available for saving banks, but for current saving is for individuals, current is for business account. So you go to a bank, you want to open a business account. So they will give you multiple choices, typically most of the modern day banks. So they'll say that if you maintain a minimum balance of 50,000 rupees, then you will get these facilities. But if you maintain a minimum balance of let's say 50,000 or 1 lakh rupee, then you will get a preferred account status. So आपके checkbook पे preferred लिख के आता है. और a lot of different banks use different terms. So that means that competition चल रहा है. So that means that at any point of time I need to have minimum 50,000 in my bank. But does it mean that's bank's money? No. That's my money. I can anytime go and take that money out. But then how is bank earning? When I maintain a minimum balance of 50,000, bank goes and gives out that money to someone as loan. And then bank earns through interest. So bank's income is interest, not the amount that you give. Anyway, so are we clear with debit and credit? Are we okay with this? Okay. Now the next part of this question is that certificate of deposit is some sort of a fixed deposit in US. We have it in India, but we won't do that now. It's like a fixed deposit. You deposited some money, and what bank did was it created your account. That means bank's liability increased. That means more cash deposited into your account. That means which is your income, and income should go to your income statement. But this next transaction, that what you did was you sold 10,000 shares at 30 and then you repurchased them at 20. So now these shares means that this is not a market investment. These shares means your own company's capital. So you issued some capital, you bought it back. Your intention was not to make profit here. Right? You buy back capital, it's a capital financing decision. This is not the business of the company, so this does not come on the income statement. Are we clear?
Where this 10,000 is going to go?
You'll understand that. It goes to balance sheet directly without going through income statement.
In case we got some profit.
Yes, we got some profit. Now the entire video, this dog barking would be. While we do a session in the class, we simultaneously capture a video through a software in my computer. So this dog is very much prominent in all the videos, and no matter which video you see on YouTube, you will hear this dog barking. I in fact tried making a video late in the night, 1:30, 2 o'clock, because I wanted a quieter place so that there is no disturbance and noise. And then when I was editing it, I realized that 1:15 this dog is barking, then 1:32 again is barking. Anyways, this is your balance sheet, liabilities, assets. Now I've done it correctly. This is your profit and loss account. This is your income, expenses. This is your income. Now, when I make some profit, when I write something here, so let's say interest income received 1000. Credit has increased, so this excess credit goes where? Profit. Yes. What I do in that case is, where I have made some profit, I issued something for 30, I bought it back at 20, so I have been benefited, I have earned some money there. But I don't want to show it on my income statement because that would be misleading to the investors. So what I simply do is I directly write down that amount here. Without routing it through the profit and loss account, I directly put that amount into my liability side. So let's say आपका income था 1000 रुपया. So had this been on the income statement, you would say income 1000, cash 1000. And then finally this income would be transferred here again on the liability side. So net effect is what? 1000 and 1000. But then in case of this particular profit, which I don't want to show on income statement, I don't use this. I don't make this entry at all. I directly show 1000 on the liability side in something called as reserves, and I show 1000 here on the asset side, cash. Are we okay? Let's take it slow. I know this is day one, so there would be certain things which might be a bit heavy, but with time, slowly you'll start learning these things. Okay, we've done this part. This concept is called as accrual. You might want to write this down. That revenue is to be recognized when it is earned, not received in cash. Expense is incurred, not paid in cash. चलिए आगे. You want to spend time here or we okay? Okay. Now the next point is long-term contract. You write down the slide. This is going to take us a lot of time. Yeah, the whole thing. Done. Increase your speed. Is it done? Okay. See, this is about put it this way. See, there was this tournament in South Africa, World Cup. One day was World Cup, right? South Africa में क्या था last time? No. It was T20 World Cup. Some World Cup was there. T20 World Cup. So उसका opening ceremony कौन से ground पे हुआ था? Johannesburg. Some ground I don't remember. So that particular ground, it was made by L&T, and it's one of the very popular cases in project management. That L&T finished their entire project in a record time of 1.5 years. It was a huge project. They were constructing a huge size of ground, and they finished it in 1.5 years. So think of company like L&T which does projects like building a dam for the government, or building roads for the government, right, or building cricket stadiums. So typically, let's say if I am building something like pens or chocolates, I would manufacture and sell within the same year. But for a company like L&T, let's say if they are doing a project on a greenfield project, a new project, okay, for, let's say they are building a dam someplace. Now this would take them 5 years. So let's assume that this particular project is going to take them 5 years. Now let's say that L&T is going to receive 200 CR from the government of India for building this particular dam. Right? Now this is year 1, this is year 2, this is year 3, this is year 4, and this is year 5. In year 1, government gave them 100, the initial funding. Then it did not pay anything in year 3, year 2 and 3. Then it paid them 50, and then it paid them 50 again. So now think from L&T's perspective, it's so practical, that how do I decide my sale is how much in which year? Is my sale, because L&T wants to prepare its profit and loss account, let's say in 2000, this is the first year. So should I say that my sale in this year is 200? Should I say this is 100? Should I say that I do not have any sale and I would recognize the entire sale at the end of year 5? What should I do?
In the first year, we should show us 200 sales.
In the first year, sales would be 200. Okay.
And 100 is the sales return.
Yes. So you are referring to accrual concept. What you are saying is this is not important. The amount of cash received is not important, not to be considered. Then what is to be considered? What is the amount of income earned? Right? This is the important thing. And what is the income earning activity here? Building dam. So if I build a dam, then I would earn my income. So then you are saying that entire dam was built in year 1 itself?
No.
So if I did not build the entire dam in year 1, I have not finished my income earning activity, then why should I say that the entire 200 is my sales here?
Because at that year, I have incurred the income in the.
No, I am not. Income earning activity is what? Building dam, not getting a contract from the government. If you get the contract, if you don't build a dam, you don't get the money.
Yeah.
Isn't it?
Yeah.
So income earning activity is building dam, which means my activity is not finished in year 1. So it's finished in which year? So which means then my sales should be 200 in year 5.
But it's partly completed everywhere. So like what?
Yes, it's partly completed everywhere. So let me just write down the cost. Let's say total cost that this company is going to incur on this project is 100, which is going to be 20 CR in each of the year. This is the cost that company is going to incur. So now if I say that project was completed here at the end of year 5, so I should recognize my sales of 200 at the end of year 5. What will happen is my expense in year 1 is 20, no sales, loss of 20, loss of 20, loss of 20, loss of 20, and suddenly profit of 180. Right? Which does not really make a lot of sense, isn't it? Because it's not that I finished the entire thing in year 5, I was doing it throughout the period. So there are two alternative methods. If you can now read what's there in your book. The first method is percentage of completion, and the next one is completed contract. If L&T is using completed contract, if the method that was used was completed contract method, L&T would say my sales here is 0, 0, 0, 0 and 100 directly. So my sales here is 200 directly, and because I would recognize my entire amount of revenue at the end of year 5. Entire 200 to be recognized at the end of year 5 when my project is over. But if I am using the other method, which is percentage of completion, let me just write this down as completed contract. The other method is percentage of completion. I would say that what percentage of project is complete in year 1, what percentage of project is complete in year 2, and so on and so forth. So the question is, how do I decide? The way it is done in real life scenario is that there are this set of people called as chartered engineers. Heard of them? So there is an examination taken by government, you need to pass that after being an engineer and you become a chartered engineer. So you go to a chartered engineer, you show him your details and you ask him that can you please give us a certificate saying that we've finished 30% of our project in year 1. Okay. Or then he might say no, you haven't finished 30, you finished only 20 or you finished only 15, so I'll give you that much of certificate. So once your chartered engineer gives you a certificate saying that you've finished 20% of project in this year, then 20% of your revenue is to be booked in this year. Next year he says that, let's say in year 1, the project which was completed was 20%. In year 2, he gave you a certificate of 50%. That means how much extra did you complete in this year? 30%. So 30% of my revenue is to be booked in this year. Right? So I want to recognize my revenue in proportion to the amount of work that I have done, the amount of project that has been completed in my year, this particular year. Are we okay with this? But then typically for CFA exams, the method which has been recommended is, how do you estimate the percentage of completion? You estimate that based on the total cost. How much is my total cost? 100. Of course, these are projected costs. I don't know in year 1 what would be cost in year 2. I just projected it. So my total projected cost is 100. If I have incurred 20% of that cost in this year, my project is complete by 20%. If I have incurred 20 here, again my project is complete by 20%, 20%, 20% and 20%. So this is how my project is getting complete over the period of 5 years. So my revenue here is going to be 40 CR, 40, 40, 40 and 40, and my profit will be 20, 20, 20 and 20. Have we followed this? So this alternate method would be percentage of completion, where how much I have completed in this year, cost incurred in this year divided by total projected cost. Right? So now, see the funny thing. How much is your sales in year 1? 40. But how much is the cash that you received from client? 100. So ideally if you made sales of 40, client gave you cash of 100, he's given you something extra. Right? So that extra that you received at this stage, what would that be? It would be a liability. It's like received income in advance. So it's a liability. If I have made sales of 40, client gives me 100, he's given me extra 60. I have to give him service of 60, otherwise I have to pay it back to him. That means my liability in year 1 is going to be 60. Year 2, I have made sales of 40 and 40 now, total 80. How much has client paid me till now? 100. How much extra? 20. So my liability here is going to be 20. Year 3, I have made total sales of 120. But how much client has paid me? 100. He's supposed to pay me 20 now. So that's going to be my asset. So I will have, this was liability. This was liability. Now I will have 20 worth of asset. In year 4, now client is supposed to pay me 160. But how much total amount he's paid me till date? 150. 100 plus 50 here, 150. So how much less is paid me? 10. So this is my asset now. Year 5, client is supposed to pay me 200 till date. How much is paid me? 200. Asset or liability? 0. So you can write down this example in better handwriting. Done? Fortunately, there is no one here who's with a red, green, and blue pen. If there were people who are currently level 2, so they has to come with all those scales, red color pen, green color pen. तुम घर पे करते हो? Deepak, are you understanding? Done? Do we move on? Ratnesh, हो गया?
Yeah.
Okay, I'm deleting this. Okay. Alright. Now we'll do one more example. Let's say the size of the project is 400 CR. Tenure is 4 years. Total estimated cost in year 1, 2, 3 and 4 is 100, 25, 25, 50. This is the cost, and cash given by client, cash received is 100, 100, 100 and 100. Use percentage of completion method and find out sales, cost, profit and asset oblique liability for all the 4 years. Done. Done with that. Cost is if sales and costs are same, then there is no benefit of doing the project. Cost has to be less than the total sales, right? At least projected. Should we do this together? Kirat, हो गया? Okay, let's do this together. This is your year 1, 2, 3 and 4. First we'll say cost, which was 100, 25, 25, 50. Total cost is 200. Percentage of project completed, 100 as a ratio to 200, 50%, 12.5%, 12.5% and 25%, total 100%. Total revenue is 400. So to find out my revenue, I just want to multiply, that's it. So 50% of revenue is to be recognized in year 1. So revenue is going to be 200, 50, 50, 100, total 400. How much is the profit? Simply sales minus cost. So sales of 200, cost of 100, profit is 100, 25, 25 and 50, total profit of 200. Cash received. Cash was 100 all the years. So 100, 100, 100 and 100. Now I would say total revenue is 200. Cash received is 100. I have a asset. And asset amount is 100. If positive is asset, negative is going to be a liability. Here my total revenue is 250. Total cash received is 200. So now asset is 50. Total revenue 300, total cash received 300, 0. Total revenue 400, total cash received 400, 0. How many of you got this right? And raise your hands. Asset liability में गड़बड़ हुआ? It is asset. How many of you got revenue right? How many of you got sales right? Sales was right. It'll come, you need some practice. After a few examples it would be clear. You want to ask something? Clear? Is it okay? Deepak, are you okay with this? Making sense? Anything you want to ask?
परसेंटेज
ठीक है, वो भी
टोटल टेक द टोटल
ठीक है. Ratnesh, are we okay? Should we move on? Just think. See, you think of it this way now. Once you have this table, year 1 में आपने sales कितना किया 200, but client ने कितना पैसा दिया? So, client ने 100 कम दिया. He is supposed to pay you so instead of 100. Year 2, अभी तक का total sale client को हुआ 250, but उससे पैसा कितना आया? 200. So instead of 50, अभी आना बाकी है. टोटल सेल्स हुआ 300, टोटल पैसा आया है 300, 0. टोटल सेल 400, टोटल मनी रिसीव्ड 400. नो असिंग, नो लाइबिलिटी. Want to do one more? You can use 5 minutes. Do you want me to twist this a bit? Similar. Okay, let's keep it simple. Use your calculators. Use percentage of completion method. Don't lose decimals, use your calculator smartly. Done. 500 is what percent? 4. 4%. This is 14.29. Okay, 14.29. So see, these are the projects which are completed. 71.4%, 14.2%, 14.2%. Your total revenue is 1000, so you want to recognize 1000 into 71.4% in year 1. That means you would recognize 714. You would recognize how much here? 142, and you would recognize 142. Is it okay? Yes, you simply multiplying with percentages. So now your sales is 714, your cost was 500, your profit for this year is how much? 214. Profit this year is, and profit here is 42. Of course, there would be some decimals here. Now once I have this, I can calculate asset and liability. I have made sales of 714. I have received cash of 1000. Have I received extra? Yes. So how much is that extra? 286. How much here? Sangram. Yes, no. Asset and liability. How much is your cost? How much is your sales? Sales minus cost is profit. Anyone with any doubts? Anything not clear, Deepak? Is it clear? Yes. The asset and liability? How much sales you've made? 714. So how much money client should have given you? Client should have given you ideally 714, but it gave you extra. That means it gave you extra of 286. These are all liabilities. I should have put them bracket. So since I have received that extra, you received income in advance. We call this as unearned revenue. Unearned revenue. You received it in advance. It's a liability. Unearned revenue. So your unearned revenue is 286. Unearned revenue is 142, and then it is 0. Yes, are we okay? Alright, then let's talk today. Tomorrow same time. Go home and try to read now. But what we have done is only one page of your choices today. That took us a lot of time. So if you can read advance, that will help. In case if you didn't understand certain small things, go back and watch level 0 videos. It's there on the website. Okay, so if you think that you're not strong with accounting as of now, go and watch those 4 set of videos. We would be repeating level 0 of accounting again next week in the evening. So we'll send you SMS for those timings. Tomorrow morning, income statement, 7:30.